Welcome back. You're watching the Buck Stops here on NDTV. I'm Shweta Rajpal. Festive cheer on Dalal Street today. The Sensex scaled to newer heights it's never seen before. Its lifetime high. But is Dalal Street celebrating too soon? The economy's fundamentals remain weak. Growth has slowed down. Inflation is still very high. But clearly what's hard to ignore is the huge turnaround in sentiment we've seen in the last 2 months alone. The rupee is now stable, corporate earnings have improved. So can we safely say the worst is over for the economy? Diwali on Dalal Street. It took 5 years and 9 months for the Sensex to scale newer peaks, touching its lifetime high of 21,293 today. Led largely by foreign inflows, as America has decided to delay tapering its stimulus plan. On the domestic front too, there's good news. Exports have picked up and gold imports have been curbed. Earnings of companies in the second quarter have been better than expected. And a bumper monsoon has pushed up rural demand and agricultural output. The rupee has also stabilized thanks to recent policy decisions taken by the RBI and the government. But a word of caution on the rally coming from none other than the finance minister.
More than anyone else, the market seemed to welcome the RBI's measures as well as the government's measures. But I would caution investors against excessive exuberance.
The pickup in exports and dip in gold imports have led Mr. Chidambaram to scale down the current account deficit target sharply from $70 billion to $60 billion now. But here's a reality check on the market rally. It's not a broad-based one, but only led by a few stocks. What's worse, the fundamentals of the economy are much weaker now. While growth has slipped from 9% to below 5% levels, the rupee has depreciated sharply from 39 to 61 to the dollar.
There are three factors which drive markets. In the immediate term, it's sentiment. In the medium term, it's valuations. And in the long term, it's fundamentals. Fundamentals, of course, are far from flattering at this point in time.
So the larger question remains, will this rally last or is there a correction in sight? With Hina Gambhir, Shweta Rajpal, NDTV. And joining me tonight to discuss whether the stock markets are reflecting the realities of the economy or not, Dr. Arvind Virmani, former Chief Economic Advisor to the government and former Executive Director of IMF. Also joining me, Meera Sanyal, Country Executive and Chairperson of the Royal Bank of Scotland. But first, to get a view on the markets, let me go across to Dr. Surjit Bhalla, MD of Oxus Fund Management. Dr. Bhalla, the Sensex making history today, touching its lifetime high. But the big question remains, are we going to see this rally continue? After all, it's not a broad-based rally. It's a rally that's being led only by a few stocks. Moreover, the overall macroeconomic fundamentals continue to remain weak.
Yeah, no, certainly there are several macroeconomic fundamentals that are worrisome. One, as you'd already mentioned, is no longer on the horizon, which is the current account deficit and the associated depreciation of the rupee. So I think at least that problem, if you will, is not exactly solved, but I think is in the comfortable zone. What is not in the comfortable zone, and certainly not as yet, is the growth of the economy, is the inflation nature of the economy, and if you will, what's going to happen if and when the tapering takes place in the US. The US economy and the other economies, you just saw China, US, etc., are doing rebounding from their growth, or if you will, accelerating. And we are stuck in the doldrums. So when will, if you will, earnings in India warrant the extension of the Sensex or the Nifty?
All right, but if we were to try and understand the reasons why we've seen this recent rally largely led by foreign inflows, which also brings in fears of a major correction, because when you see hot money coming in, there are also fears of that money flowing out of emerging economies like India, as and when America decides to taper its stimulus program. So those worries out there.
Yeah, no, I think that's a good, there are two sides as usual. There are two sides to the story. One is the Indian market had been beaten down quite substantially. So we have played a bit of catch up with the rest of the world, and now we are broadly, if you will, caught up. There are some estimates as to what it is with respect to inflation, etc., and I don't think stock markets are like real value. They go by what is expected in terms of inflation, they go by what is expected in terms of growth, and they go by what is expected in terms of interest rates. On all three counts, the Indian economy is in trouble. It's not clear that we'll get out of it very soon, but there is anticipation that the worst is over, and that perhaps is correct. I also belong to the camp that the worst is over, but I'm not so sure that we are seeing anything like the V-shaped recovery that we have seen in the stock market, that we are seeing that in the real economy. And that's the big divide, if you will. That's the big dilemma. And we'll need to see how it resolves itself.
Right, it is a big divide, it is a big dilemma, because what's happening in the markets isn't exactly what's happening in the economy. The economy, as you said, is still in trouble. So why are we seeing such a big difference in the way equity markets are behaving and the real state of the economy? It is a really confusing picture out there as to where the economy stands.
Yeah, it's the macro of the economy that is problematic. Now, one possibility could be that the stock market is, and I think it is a possibility, is looking for a regime change come election time. So in that sense, but I think that's 6 months away, and it's a bit too much in advance to anticipate. And politics is never a very straightforward issue, especially not in India.